4 decades, the US dollar has been the world's dominant reserve currency. It's been the cornerstone of global trade, the standard for international transactions, and a store of value for governments, investors, and individuals alike. However, in recent years, there has been growing concern about the US dollar's future. Experts and analysts are predicting that the dollar could face a significant decline in the coming years. But what does this mean for you and your money? How will the weakening of the US dollar affect your financial life, from your savings to your investments? In this video, we're going to explore the factors contributing to the US dollar's decline, the potential consequences of this shift, and most importantly, how you can prepare for the coming changes. The impact of a weakening dollar is something everyone, from everyday consumers to high-net-worth investors, needs to understand. Let's dive into how this will affect you and what steps you can take to protect your wealth. Part 1. Understanding the decline of the US dollar. Before we get into how the dollar's decline will affect your money, it's important to first understand why the US dollar is facing challenges in the first place. The US dollar has enjoyed dominance for over 70 years, ever since the Bretton Woods Agreement in 1944 established the dollar as the world's reserve currency. This status allowed the US to borrow cheaply, maintain large trade deficits, and exert substantial influence over global financial systems. However, over time, several factors have started to undermine this position. Inflation and currency devaluation. One of the most significant drivers behind the decline of the US dollar is inflation. The US government's increasing reliance on printing money to finance its spending, particularly in response to crises like the 2008 financial crash and the COVID-19 pandemic, has led to a steady devaluation of the dollar. The Federal Reserve's policies of low interest rates and money printing, known as quantitative easing, have pumped vast amounts of money into the economy, which ultimately lowers the purchasing power of the dollar. Rising national debt. The U.S. national debt is another key factor in the dollar's decline. As the government borrows more money to fund its deficit, the total debt continues to grow, putting downward pressure on the dollar. The U.S. debt now exceeds $30 trillion, and with interest payments on this debt rising, the dollar's future stability is uncertain. Global diversification away from the dollar. On the global stage, there has been a noticeable shift in how foreign countries view the dollar. For decades, the US dollar has been the currency of choice for international trade and reserves. But now, many countries are looking for alternatives. China and Russia, for example, have been increasingly using their own currencies for trade and investing in gold and other assets as a hedge against dollar weakness. Furthermore, some nations are exploring the possibility of creating new reserve currencies or using the International Monetary Fund's special drawing rights, SDRs, as a global currency. The rise of cryptocurrencies and digital currencies. The emergence of cryptocurrencies like Bitcoin and Ethereum, as well as the exploration of central bank digital currencies, CBDCs, also poses a threat to the US dollar's dominance. As these alternatives grow in popularity and usability, they could further erode demand for the dollar, especially in cross-border transactions. Part 2. How the dollar's decline will impact you. Now that we understand why the US dollar is facing a decline, let's look at the specific ways this shift will affect you, your money, and your financial future. Higher costs for goods and services. The most immediate effect of a declining dollar is the impact it will have on the prices of goods and services. As the value of the dollar decreases, the cost of imported goods will rise. Since the US imports a significant amount of its goods, from electronics to consumer products, the prices of everyday items like food, gas, electronics, and clothing will likely increase. This phenomenon, known as inflation, is something we're already seeing today as prices rise at the fastest rate in decades. For consumers, a weaker dollar means less purchasing power. What you could afford with $1 today will cost you more tomorrow. If wages do not keep pace with inflation, the decline of the dollar could lead to a decrease in your standard of living. For those on fixed incomes, such as retirees relying on Social Security, the effects could be especially painful as the purchasing power of their income declines. Impact on investments. A decline in the US dollar will also affect the value of investments. If the dollar loses its value relative to other currencies, it can have a significant impact on stocks, bonds, and other assets. For example, stocks of companies that rely heavily on international trade or that import raw materials may see their profits shrink due to the rising cost of imports. Meanwhile, if inflation continues to erode the value of the dollar, traditional fixed-income investments like bonds could become less attractive, as their returns would be diminished in real terms. On the flip side, some assets tend to perform better when the dollar weakens. Gold, silver, and other precious metals have historically been seen as safe haven investments in times of dollar weakness. As the dollar loses value, these assets may rise in price, offering some protection against inflation. Additionally, foreign stocks and commodities priced in other currencies could benefit from a weaker dollar, as the value of those assets increases when converted back to US dollars. Higher interest rates and debt burden. To combat inflation and a weakening currency, the Federal Reserve may raise interest rates. While higher rates can help stabilize the economy and protect the value of the dollar, they also increase the cost of borrowing. For individuals, this means higher rates on mortgages, car loans, credit cards, and other forms of credit. If you have outstanding debt, the rising interest rates could make it more expensive to service that debt. For those with adjustable-rate mortgages or loans, a weakening dollar could lead to a significant increase in monthly payments, putting additional pressure on household budgets. This could lead to a rise in defaults and bankruptcies, especially among those who are already struggling with debt. Changes in global travel and tourism. A weaker dollar also means that traveling abroad will become more expensive. Since many countries price goods and services in their own currencies, U.S. travelers will find that their dollars won't stretch as far as they used to. This could lead to a decline in international tourism, as travelers may opt to stay closer to home or travel to countries with favorable exchange rates. On the flip side, foreign tourists may find the U.S. more affordable, which could boost tourism in the short term. The changing role of the dollar in global trade. As mentioned earlier, the decline of the U.S. dollar may not just affect individuals, but also the broader global financial system. If more countries shift away from using the dollar for trade and reserve currency purposes, the U.S. could face higher borrowing costs. Without the demand for dollars in international markets, the U.S. could find it more difficult to finance its budget deficit, leading to further debt accumulation and a worsening of the dollar's value. For U.S. businesses that rely on imports or do business abroad, the decline of the dollar could hurt their profitability. On the other hand, exporters may benefit from a weaker dollar, as their products become cheaper for foreign buyers. Part 3. How to protect your money from a declining dollar. Now that we've explored the potential impacts of a declining U.S. dollar, the next question is, what can you do to protect your wealth and financial future? Here are some strategies to consider. Diversify your investments. One of the most important steps you can take is to diversify your investments. Don't keep all your money in U.S. dollars or dollar-denominated assets. Consider investing in foreign stocks, commodities, real estate, or precious metals, which can provide a hedge against dollar weakness. By spreading your risk across various asset classes and currencies, you can reduce the impact of a falling dollar on your overall portfolio. Invest in precious metals. Historically, gold and silver have been seen as stores of value during periods of currency devaluation. Precious metals tend to perform well when the value of fiat currencies like the US dollar falls. Investing in gold or silver could help protect your wealth in an inflationary environment. You can invest in physical metals, exchange-traded funds (ETFs), or mining stocks, depending on your risk tolerance and investment goals. Consider foreign currencies. If the US dollar is weakening, you might want to consider investing in foreign currencies or currency ETFs. Currencies like the Swiss franc, the euro, or even emerging market currencies can provide a hedge against dollar depreciation. By holding foreign currencies, you can potentially profit from the US dollar's decline. Reduce debt and increase savings. If the dollar weakens, borrowing will become more expensive. Now is a good time to pay down high-interest debt, particularly credit card balances, loans, or adjustable-rate mortgages. Reducing your debt will make it easier to weather periods of rising interest rates and economic instability. Additionally, building up cash savings can help you navigate any financial challenges that arise from a weakening dollar. Focus on real assets. Investing in real assets such as real estate or commodities can provide protection from inflation and currency devaluation. Real estate tends to appreciate over time, and commodities like oil, agricultural products, and metals can hold value in an inflationary environment. Conclusion. The decline of the US dollar is a trend that could significantly impact your money in the coming years. From higher costs for goods and services to potential changes in global trade dynamics, the effects of a weaker dollar will be felt across the economy. However, by understanding the risks and taking steps to protect your wealth, you can navigate this shift more effectively. Diversifying your investments, investing in precious metals, reducing debt, and holding real assets are just a few of the strategies that can help safeguard your financial future in an uncertain economic environment. Stay informed, take action, and be prepared for what's ahead. Thank you for watching. If you found this video helpful, don't forget to like, share, and subscribe for more insights on how global economic trends affect your personal finances. Stay proactive and take control of your money today.